we appreciate them very much, even if I can't say it the first time right. We got this grant as a pilot program to be able to provide resources to the community for a variety of financial literacy, home ownership resources, things like that, to make sure that we are serving all of our community and helping everybody stay in their homes, and whoever wants to stay in the community should be able to stay in the community. And this is one way of being able to provide the information and resources people need to be able to stay in the community. With me today is Daniel Bennett, and he's from WaFd. And been very gracious and very informative already today, talking with us informally. And so he's going to be providing a whole lot of information about the financial literacy side of the equation here. And so if you don't mind to introduce yourself a little.
Awesome. Well, thanks for having me, first off. So my name is Daniel Bennett. I am with WaFd Bank. WaFd is WaFd. There's an E missing, right? So, but WaFd Bank is a bank that is based on the West Coast. We're based out of Seattle. There's about 200 locations in 9 Western states. WaFd is a very relationship-driven bank, and the goal is to be a part of the communities that we serve. We have one location here in the Austin area, which is, of course, adjacent in some ways to Smithville. And what we try to do is make sure that we have those relationships with our clients to help them receive the knowledge that they need to be successful in all of their financial goals, and not just their financial goals, but their family goals and any goals that they might have, right? And so we do that by partnering with organizations like this one to be able to provide financial literacy. Financial literacy is geared around discipline, and so we try to teach people the information that they need to be able to do that. A bit more about myself, though. I've been in banking now for about 14 years, and I've worn a lot of different hats. I also partner with other organizations in the community. One is called A Little Bit of Good, which is a Black-led nonprofit that helps other Black-led nonprofits bridge the funding gap. So we make sure that they're ready and for funding, right? I also sit on the board of EGBI, which is the Economic Growth Business Incubators. Really great organization to help entrepreneurs with their goals, with their business. I also sit on the board of the National Association of Black Accountants, which is their big thing is being able to lift as they climb, right? So we help a lot of the students in the area get ready for a background in accounting and any other finance-related professions. So I try to wear a lot of hats, but my biggest goal is to be a good person, to help people where I can help people. And today I hope that I can provide enough information that you can at least be dangerous out there, right? You know, a lot of times what we fail from isn't because we don't want to do better. It's because we don't necessarily have access to the information. And my goal is to provide that. So I know it can be long-winded, but thanks for having me today.
Oh, really appreciate it, Daniel. Thank you for that. Really appreciate that.
Absolutely.
Yeah, and looking forward to doing some good work in Smithville with you as well. So first question to start things off is, why do you need a bank account?
So I think that's a great question. Why do you need a bank account? So a lot of times when I speak with different people, you know, there's an inherent fear of banking. I think back in 1932-ish, we had the Great Depression, and it kind of changed our perception of banking in general, right? People started to fear, like, bankers have this bad name. We've had all kinds of different things going on where there was redlining at one point. There were, even recently, there were larger banks that had financial scams going on where they were opening accounts that they shouldn't have been opening. But I think the reason that you have to have a bank account is it's because it's what I like to call your financial footprint, right? What I mean by financial footprint is it gives the people that you'll have to do any kind of financial transactions with some way of seeing who you are as a financial person, right? So it's much like, I always attribute banking to your healthcare professionals, right? So when you go to a healthcare professional and you say, I have a headache, they don't immediately go and say, okay, well, here's a medication for it, right? They look at a background. They look at your chart, right? And they check the chart and they say, well, do you have diabetes? Do you have high blood pressure? Do you have all of these other things going on? And then they make a determination of what's due for that ailment, right? So why you need a checking account or a bank account in general is because it creates your chart, right? What it does is it will help you establish what is called a bank statement, right? That bank statement, what it does is it shows everything that you're doing with your money. It shows us where you're spending your money. It shows us where you're getting your money from. It shows us your financial history. Now, it's just one piece of a grander puzzle, But it's what I like to say, the financial footprint, it's the first step that you take to kind of establish, hey, this is what I'm doing with my money. And let's say you go to a lender, right? And let's say you want to buy a house or a car or some kind of lending situation where you can't pay it out front. The first thing they're going to ask for is your bank statement. Show me your bank statement. And that bank statement is going to say, hey, this is what I've been doing. And then they will evaluate that. They'll ask for other documents. But if you don't establish that some way, they don't really have a way to do anything with you, right? And of course, it gives you access to different things. You'll get your debit cards. You'll get other things that you can use to make financial transactions. But whether you go to a bank or you go to a credit union, it's always good to establish some kind of bank account. But here's the biggest kicker, right? The biggest kicker is you get a financial professional, right? And why is that financial professional important? Is because they are supposed to be. Now, I think that we've come to a place in society where everything's become digital and everybody's like, go online, check the internet. I pride myself with WaFd Bank because we're really old school, right? We still want you to come in, or we'll come to you, we'll shake your hand and say, hey, what do you have going on? But your financial professional is like your doctor, right? So they're the one who you go to and say, hey, I've got an issue, I've got something going on, I need some help. And so they can provide you the information that you need. They can connect you with the right people. Bankers have a tendency to connect with a lot of people, do a whole lot of networking. So sometimes they can refer you to an attorney if you need an attorney. They can refer you to an accountant if you need an accountant. They can refer you to another business owner who they may already work with if you have another business need. So that financial professional looks at the whole picture, holistic approach, and they say, hey, this is where you are in your financial journey. This is where you told me you want to be, and this is how we'll go about navigating. So I know that's a long answer to a short question, excuse me, but that is why I think you need to establish a bank account.
Very good. Okay, and what is the difference between a bank and a credit union?
So for the most part, the differences between a bank and a credit union is how they are funded, right? So many banks are what we call FDIC insured, right? FDIC is a federal organization that makes sure that we don't have another, or the attempt is to make sure that we don't have another Great Depression situation. So we've had a few banks here in the recent near future that have had to implement FDIC insurance, right? And what that did was, although there was what we call a run on the bank, where people come and they get all of their funds from that bank in a short period of time and they don't have enough funds to really cover that, it ensures that the consumer, us, we're all the consumer when it comes to banking, right? They are protected with their funds. So you're covered in certain, and I don't want to go into the details of the FDIC, the magic number for the most part is 250,000. For most of us, that's a pretty good round number to help you remember, I'm protected in this case. Now, there are other ways to be insured for more through the FDIC, but that's how it protects, right? And then with a credit union, they use another organization, and you'll have to forgive me because I don't know their organization's acronym off the top of my head, but they use another organization. But the way they're funded is completely different, and the way they're owned is different. So a credit union is usually funded by its members, and the ownership is by the members. So what that does is it gives them the ability to make changes that aren't as regulated as a bank would be. And so there's pros and cons on both sides. So usually with a credit union, it's a situation where you can get smaller lending opportunities with ease and less paperwork, but there are limited protections, right? So I think both have their advantages. I'm a bank guy. I might have a slight bias, I won't lie. Right? But I think that banks have a tendency to be a little stronger than a credit union because of the back and the way that they make their money. So banks will borrow money from the federal government, right? And then they lend that money out and they charge an interest rate on that money. But it's a really funny term because it's called buying money, right? And so you never really think about buying money, but the bank has to buy their money from the federal government and then they lend it back at another rate so that they can make money. And so we can get into the intricacies of that, but I think that's a pretty wide understanding of the differences. Yeah.
Okay, and so what exactly do you need to open a bank account?
So it does change from industry to industry or bank to bank, right? And so it's generally not very hard to open a bank account. And I think there is there's a bit of a shroud around what it takes. Some people think that you have to come in with your birth certificate, your social security card, and you've got to have this slew of documents in place in order to open a bank account. In fact, it's gotten so easy in today's society that really, for the most part, all you need is some kind of state-issued ID with a photo and an address. The reason you need a photo and an address is because our banking system, credit union or a regular bank, it's designed to be a first layer of defense against terrorism. A lot of people don't recognize that, right? But it's there so that we can make sure that we can put a face to the money. Where is the money going? What is it being used for? So that state-issued ID usually is the easiest route. But some sort of ID that has a picture and an address will help you be able to open that account. And then some places will require a second form of ID. And for anybody who is not a U.S. citizen, usually you'll have to have some form of documentation showing your legal status in the country, right? With that, you usually have to bring an opening deposit. Most banks will start at about a $25 deposit. There is a misconception there. It's not the cost of the account that is deposited into your account. You keep those funds, but it helps to establish the account. It's definitely an easy process, but it even gets easier. Most banks, including WaFd Bank, will allow you to open an account online. So you can just go on to the .com address, whether that's wafdbank.com or any other bank you go to, and you can click open now. And you input your information just like any other application, and usually you can have an account open in a matter of minutes. Sometimes they will require more information to have you visit the bank just so that you can show that ID or you can, clarify some other things. But it's a super easy process. But again, your financial professional is your best route. So if you ever have any questions, it's usually free to talk to a banker. They're excited to talk to you because we've come to a place, like I said, where nobody really wants to come in anymore. We want to invite you in because ask those questions, like, what do I need? Because sometimes there's ways around it. I've actually been able to work with a lot of people in the unhoused community to be able to help them get established because IDs are hard to come by for them. One of the things that we've been able to find is the Austin Public Library offers what's called an enhanced library card, where it gives a picture and an address, and it can be used to open an account. So there's usually other ways to get through it, even if you have issues with identification. So relatively easy.
Okay, fantastic. Well, thank you. So the other question about that is, what do you do to earn interest at a bank? There's several different kinds of accounts, checking, savings, other kinds. So what's the interest?
Awesome. So interest is an interesting subject. No pun intended, right? So there are multiple kinds of interest, and banks usually pay what's called compounding interest. So compounding interest, for the sake of understanding, is you're earning money on the money that you've earned. So let's say you put $1,000 in, you've earned 1 cent. You're going to now earn more money on that 1,001 cent, and so you'll earn even more and more. And so it compounds. It's a really simple concept, right? But there are several different account types that earn interest at a bank. They have money market accounts, they have CDs, they have regular savings accounts, and then we can get into other things like investment accounts, those types of things, but I don't want to go deep off into the weeds. The thing that I think is most important to the everyday person like myself, right? It's understanding that interest isn't always your primary thing to be concerned with. A lot of the things that you want to be concerned with at a bank is protection, right? How you earn interest, though, is simple. You put the funds in the account, you have to choose the right account, and then you'll be given an interest rate. Those interest rates, usually on a CD, a CD or a savings account, at this stage in our economic picture, they don't pay a whole ton of interest, right? But it is there so that you're earning something rather than nothing. You can earn 1% of 100, or you can earn 0% of 100, but it's completely up to you. So the bigger thing there is protection. Now, there's interest that you've earned on savings accounts and CDs as well, but there are other products that charge interest. And I like to make sure that I show that contrasting relationship and interest, because there is a little bit of confusion that I've come across where people don't understand the difference. So if you're putting money into like a CD or a savings account, money market, you will be earning interest on the money that you have there. But if you have like a credit card, a mortgage, an auto loan, and those types of things, you'll hear the same term interest, but this time they're taking money from you. And you'll find that the money that you're paying on interest is usually more than you're earning on interest, which is the trick, right? But there are a lot of different ways when you really understand the relationship with interest on how to use it. For instance, a little trick that you'll hear sometimes is you have a credit card that has cashback rewards, right? If you pay that card off before they charge you interest, usually within the first 28, 30 days, then you'll get those cashback rewards, which usually equate more than you actually would get if you were earning interest in a savings account. So it's, I don't like to call it gamification of the system, but it's understanding the relationship of interest to use it to your advantage. So I think that's one of the easiest ways to earn interest is to put it in a CD, put it in a savings account. But interest is compounding. So it's based on the amount that you put in the account. So you'll earn a lot more interest on $10,000 than you would on $100, right? But it all depends. The biggest thing with interest is continually adding to that account. It's the discipline that you have to make sure that that number continues to grow, not just by watching the interest add to it, by adding to it organically through you adding money to that account.
Okay, so the next thing we wanted to talk about was how to build a budget. Why is a budget important? What can we expect from? What's the good things about having a budget in place?
Awesome. So I think the question there is, well, what is a budget?
What is a budget?
What is a budget, right? So I think a budget is pretty simple, and I think that we all have a budget because one way or another you're going to have a budget whether you utilize it or not. And what a budget is just what can I do with my money? How can I use my money? So we have a certain amount of money coming in, usually in most cases. Not everybody has the same amount of money. It's just how you use it and how you manage it. So a budget just allows you to dictate, I've got X amount of dollars that come in wherever they come from, but I have this certain set of expenses that I have to deal with, these certain obligations that I have to manage, and how do I do that? My biggest thing with the budget, and I tell this to everybody that I talk to, right? If you don't write your budget down, you may as well not have a budget, right? Because the big thing about a budget is understanding where your money goes. There's that saying, like, my check doesn't, or the month outlasts my check, right? And I think we run into that a lot, right? We run into that issue. And the reason you've got much more month than you've got income, right, is because you have not taken the steps necessary to make sure that you know where every dollar goes. So what I always recommend to people is if you work a job where you're paid bi-weekly, bi-monthly, however you're paid, the key is know how much money you're bringing in. That's step one on your budget. Write it down. This is how much money I'm getting every month. And then you have certain things that are called fixed expenses, then you'll have variable expenses. Some ideas of things that are fixed expenses. Insurance for your auto, it's usually a fixed expense, right? Insurance for your home, fixed expense. Things that could be variable. Your electricity bill, it could change, right? Your car note's usually a fixed expense. Your water bill, it could change. Your daycare bill could be fixed, could change, right? But the key now is to know these are my expenditures. These are the things that I absolutely have to pay each time. Those come next, write them down. They're always the same. The variable ones, the ones that could fluctuate, I always say look for an average. Take your monthly statement that you're getting from your bank account, right? Look at the average of like, this is how much I'm typically spending on these things, and then go a bit over that. That way you give yourself breathing room, cushion. Now, what I've also run into is everybody's like, well, I don't make a lot of money. You still have to spend it. There's no way to live in this country, even the poorest person that doesn't get a lot of money. There's no way to live in this country with $0. So you're getting something, right? And it's completely up to you on how you budget those funds. So you have to make sure you know, like, this is what I've got to have. And be honest with yourself. If you've got things that you buy regularly that you probably like, hey, I probably shouldn't be buying this, but you know that you're going to buy it, make sure that that's on the budget, right? Be honest with yourself because it's your budget, and that's the key, right? So after you've got your expenses, this is my favorite one. Fun money. Everybody forgets to add the fun money to the budget because there is going to be a moment where you're like, I want to go do something, right? It doesn't matter if it's going to the movies, doesn't matter if it's going hang out with friends, whatever it might be, you have to make sure that's included as well. Now, I saved the best for last, but it's actually the thing that goes first. It's your savings. your savings. We can say that 10 times more, right? Your savings, right? So let me not say what I say. Let me say what Warren Buffett says. I don't know if anybody knows Warren Buffett, but he's got a little bit of money, right? So Warren Buffett is an American businessman. He's an investor, philanthropist. He does it all, right? But his saying is, don't save what is left after spending, but spend what is left after saving, right? Mm-hmm. Now, everybody's like, well, I don't have any money to save. That's where the honesty comes in, right? You've got to look at where are my expenses going? And once you see that budget, you're able to determine, like, do I really need Netflix? Do I really have to have that coffee today? And I hate when people use the coffee analogy because I have to have my coffee. Gotta have it. So that's a set expense, right? But when you're able to look at your expenses and you're able to see, like, hey, this is how much money I have coming in. This is how much that has to go out. Then you're able to make those small tweaks, those small adjustments to say, hey, I can save. And then you put that savings right at the top of the list, right? At the top of the list, and you save because you never know what tomorrow holds. Because if your life is anything like mine, as soon as you're thinking that you're doing good, your tire's gonna blow, right? And so you've got to make sure that money is there. I'm sitting right now. My AC is broken at my house, and it's Texas. It's 93 degrees. I've got a warranty. They're saying we're not going to cover it, but you've got to make sure that you've got a way to take care of that issue. And so I'm not as worried about it right now because I will be able to take care of it. But it all comes down to making sure that you've got all of those things in place. And then you've got your charitable donations, your church. I put 10% aside for my tithe every month, right? Every check. And it's really important to make sure that you include all of those things. So if you're going to be honest with anybody, be honest with your budget, because you've got to determine, like for me, one of the places that I know that I can always take some money away from the budget is eating out. I don't have to eat out all the time, right? Is it easy? Is it more convenient? Yes, because I'm always doing something, so I can just stop at a place and get some food. But when I look at my budget, I'm like, hey, I need to save more, right? I can definitely say maybe that extra 10 minutes can be spent cooking rather than going out. And I can pack a lunch and I can have food, right? So the budget is huge. It's really, really big, but it has to be written down. I think many of us really go off the tracks because we keep our budget in our head. They're like, oh, I'm good. And we rely heavily on that bank statement and our online banking. I think that's one of the biggest cripplers that I've seen in the modern day is I'll just check my bank account on my phone and I'll see how much money, I've got it, and then I swipe my card. You know, that is a challenge, but you can't rely on just that online banking to be your tracker to say, hey, this is how much I have. It's going to be up to you to have the discipline necessary to say, if I don't have the money today, I don't need it right now. If I don't have it in the budget, maybe it has to wait. But prioritization is a really big thing too. You've got to know which things might have to take a back seat sometimes, but I think that's what a budget is. That's why it's important. It really is income and expenses. How much money do I have coming in? We focus so heavily on the expenses, but sometimes the focus has to be on the income as well, right? And so if I don't have enough money coming in, what can I do to add that second income stream or that third income stream? Do I have a hobby that I can turn into a business? Do I have some means that I can bring in more funds, and then you can create a different budget? But it's completely up to you. We all have the same 24 hours in a day.
That's great advice, and I love that turning a hobby into like that entrepreneurship that Paul talks. We won't talk about that today probably, but I hope we can talk about that.
Absolutely. I love entrepreneurship. My background is in business. I have my MBA, and I feel like business is the thing that makes the most sense to me. My wife doesn't believe it as much because I always say even a relationship is a business. Somebody's got to be the CEO. I don't know if I am.
You're a smart guy.
But business is everything, and I think that you start as a consumer, but when you start looking at it, everybody's got the potential. Now, I don't think everybody is an entrepreneur, but everybody's got the potential. But income streams are how you really affect that budget.
Okay, and you had mentioned a little bit about credit. I wanted to ask you a little bit about what is a credit score and how would you improve your credit score here?
Awesome. So a credit score, it's this mysterious number that literally dictates our life, right? So a lot of information comes around credit, right? But we've now been given so many different platforms that will help us monitor our credit. With WaFd Bank, we've got credit FICO scores that you can get. Many of your credit cards out there today will give you a FICO score. There's apps that you can download that will give you your FICO score. And FICO is just this mysterious number that's created through an algorithm. It's math, guys, and it's really not that complex. But the key is to keep track of it. It's much like your budget. If you're watching it and you're paying attention to it, you can conquer it. So a lot of people don't know, but your credit scores range usually from about 300 to 850, right? Now, you've heard higher scores. There are different algorithms that they use for different scoring systems. But I like to think of the credit bureaus, which are the people that create these algorithms and give you these numbers, as a buddy, as a friend, just somebody who's vouching for you, right? They're the person that says they're good for it, right? Or, nah, I wouldn't loan them any money, right? So how do you keep track of that and how do you build that? It's through what we call the credit mix. Now, let me be clear, WaFd Bank does not offer credit advice. I don't offer credit advice, but I can tell you how it works, right? So there's a credit mix, and so they're looking at different things like your revolving lines of credit. They're looking at your installment lines of credit. They're looking at any kind of utility type things that you have. It's all dependent on how disciplined you are. So it will accompany your bank statement whenever you meet with a lender or somebody who is offering you funds to buy a house, to buy a car, to buy your boat, your motorcycle, whatever it is that you're buying. I don't have a boat or a motorcycle. Anyway, but what it does is it accompanies them, and they look at these scores. The score, it's not an arbitrary number, but it's a number designed to say, this is this person's, instead of saying creditworthiness, trustworthiness. Because I think that your credit score is just the amount of trust that you are worthy of. Do you do what it is that you say that you're going to do? So if I loan you money, are you going to give me my money back? And how do I know that? Is because several other people, several organizations have reported and said, this is how this person has managed their money. They returned the funds that they borrowed the same way that they said that they would. And so your credit score is then assigned to you there. So the lower number, I had this question before, so don't be surprised. The lower number is the bad side. The higher number is the good side. Now people often ask, well, what if I don't have any credit? Well, let's think that through, right? So if I don't have any credit, and let's just say it's you or I, you don't know me from the man on the moon, right? And I came and I said, can I borrow $10,000? What do you say? No, no, it's not gonna happen, right? That's the same as having no credit because you don't know how much I can be trusted with that $10,000, right? Now let's say that I borrowed $10,000 from a relative of yours, a friend of yours, and they came and they said, hey, Daniel's good to borrow money. He always pays back the same way that he says that he's gonna pay back. And now I come to you and I say, hey, can I borrow $10,000? What are you gonna do?
I'm gonna think about it.
You're gonna think about it. And I love that answer because you're not gonna immediately say yes because there's a whole lot of other factors that come into, am I gonna let you borrow this money, right? And so that comes like, well, what did he borrow from you? Well, why did he borrow it from you? How long did it take for him to get it back to you? Were there any issues at all? And how often has he had to do this? How many times did he come to you and borrow this money? Why does he keep having to borrow so much money? What's he doing with his own money, right? And so creditors will take all of this into consideration, and they do that through analyzing your credit scores and your credit reports. But if you don't know how your credit scores and credit reports work, you're gonna be surprised when you get to the lender and they're gonna be like, hey, can you tell me about this? And you're like, oh, well, that is this. And so it's important for us to monitor our own credit scores, and we can do that by going to annualcreditreport.com. It's a free system that will allow you to go to each one of the credit bureaus, Equifax, TransUnion, and Experian. And those three bureaus, they might not give you the score for free. They will give you the information on your credit performance, right? It's the first line of defense in determining, has there been any fraud on my credit reports? Is anybody using my social? Is anybody doing anything like that? Are there any scams that are happening? Things that have paid off, have they really been removed from our report? Are they reporting regularly to say that I've been paying my bills the way that I need to pay my bills? And so you can get that once a year. always check that, make sure that you know what's going on. And then you can actually purchase your credit scores, which I think is the better way to do it. Because each time you check your credit, they do put a ding in your credit report. But if you purchase the scores, it doesn't cost. And it's only $15, $20 to get those scores from each one of the bureaus. But it's important to know that, right? So now that you know what's on the report, you can address each of those issues, dispute things that you need to dispute. You can handle all of the things that you need to handle with your credit scores before you get to a lender. Now, here's the catch. It goes back to that savings thing that we talked about. You may never need a credit score. My dad is one who doesn't believe in a credit score. My dad, my entire life, but mind you, my dad's 82, so it's a different day and age, right? So he bought everything cash. His house was bought cash. His cars were bought cash. Don't get me wrong. My dad's not a rich man, but I don't come from money in any stretch of the imagination. But he saved the hard way. He was like, hey, I'm putting money aside. We did without with a lot of things, but he put money aside. And so he never had to sit at a table where anybody analyzed his credit report. In fact, he didn't have a credit score for years. I think he got his first credit card because he was going on a flight. And they said, we don't take cash. He thought that was outrageous, right? But that's the way around the credit score because you can pay for it cash. Now, the average house in the Austin area is about $400,000 to $600,000. Now, if you've saved that up, then you don't need a credit score. I think my dad's first house was $10,000. It's a major difference, right? So if you don't have that kind of money sitting around, then you're going to need to monitor these scores. You're going to need to know how these all work. And then you'll need to understand the mixed up credit, right? Because when I went to buy my first house, I thought I had a great credit score. I thought that everything was in line. And she was like, hey, you don't have enough revolving credit. And at the time, I had no idea what revolving credit even meant. She was like, you have to have credit cards. I was like, I thought credit cards were bad, right? But it was an understanding of using these credit products to your advantage rather than letting them take advantage of you, right? And so after adding those credit cards to my account, she said to have around 3, and I've learned, through the years that that's a pretty good number. Now, it's not the same for everybody. Everybody has a different credit mix. But by adding those and then using them wisely, I was able to create a credit mix where I had my auto loan, which is an installment loan, meaning that I pay the same amount each month, whereas a revolving, it kind of makes a circle where I pay it, it becomes available again, thus the term revolving, right? That credit mix then gave me the numbers that were necessary for the algorithm, for the credit bureaus to say, hey, this guy's good for it. So I think that's a good answer to how credit works, where you could go with that. But again, you're going to always hear me say, go back to your financial doctor, your financial professional, and say, hey, would you take a look at this with me and say, hey, does this make any sense? Where do you think that I could do a little better? And your banker, while we don't give credit advice, they can definitely say, hey, this looks like something we've got to look into. Or if I don't know, let me refer you to a friend. Let me refer you to somebody who can help you better than I can.
Okay.
Absolutely.
So while we're still on credit, you had mentioned a little bit about paying back your credit card. We had talked earlier, we were saying that credit, the interest on credit is around 28% these days. And so a couple of things to help people understand about how much they need to pay off on a credit card. You mentioned cash back, all that. Can you talk a little bit about how that whole scenario comes?
So credit cards can be a tricky beast, right? I have seen credit cards completely demolish people's financial health, right? But I tell people, don't be afraid of the credit card. Be afraid of your own discipline, right? You have to be afraid of yourself. If you don't know how to have the self-control necessary to budget on a credit card, did you hear that word? Budget on a credit card, then maybe it's not for you. Not everything is for everybody, right? I think that might be why my dad didn't get involved with credit cards, right? But the understanding of a credit card is you want to use a percentage, right? And the average that you'll hear in the financial industry is anywhere from 30 to 40% of the balance available on that card. When you exceed that 30 to 40% of the balance available on the card, you run into that question again, which is, why do you need to borrow so much money, right? And then if you're maintaining that balance, it's like, why aren't you able to pay me back so quick, right? And so you kind of create those questions. And I always try to get people to think of it from a person-to-person perspective rather than a person-to-business. Because if you had a buddy who was loaning you money and you were holding it for a longer period of time, they're going to be like, hey, what's going on? And it's the same thing with those creditors, right? And so you want to try to keep that balance, that outstanding balance, the balance that you owe, under that 30 to 40 mark, right? And then understanding that if you pay off that entire balance before the end of what's called a billing cycle, 28, 30 days, right? Then you won't pay any interest on it. But any balance that you're carrying on that credit card, you will pay the interest on it. Now, the interest rate is determined by, again, our buddies, Equifax, TransUnion, and Experian, and they will help us determine what rate should I give you. How did they determine it? Are you on the high side of the 850 or are you on the low side of the 300? Certain cards will give you certain benefits and those types of things based on that scoring range. But once you're there, they will determine. So I've seen average around 28, 29% with interest rates on credit cards. But that varies widely from person to person, depending on their credit scores, credit mix. But then understanding that you have to keep track of that, right? So I've seen people use credit cards with what appears to be wisely, right? Which would be, I use the money on my card and I pay it off every month. And they're doing it with the goal of credit building, but they're not seeing any increase in their credit scores. And the question is why? Well, it's that same question. It's like, I know that you can pay me off every time, but how do I know that you can carry a balance and pay something larger, right? So like, if I'm buying a house, $400,000, you can't pay that all off right now. So I need to know that you can carry a balance for a while. I need to know that you can make regular payments. And that's something that they look at as well. So it's really complex how that works because it's all a little tricky algorithm, but understanding that and really playing with that mix will help. But that's usually what I try to teach people when it comes to credit cards is understanding that you want to keep your balances low. There's also what's called credit card utilization. So what happens there is you can have multiple credit cards, but your available credit is extended. So if you've got one card that you carry no balances on, but it's a $10,000 credit card, and then you've got another card over here, it's just a $500 credit card, and then you've got another card over here that's a $1,000 credit card, and the only one that you're carrying a balance on is the $500 card. You've got all of the rest of this credit available, and then you go to buy, let's say, a car, and they're like, well, your credit's too extended. You're like, well, I don't owe anybody anything, but you've got all of this available credit to you, which basically means if one day you decided I'm gonna go buck wild, and I just wanna, throw everything to the wind, and you wanna use all of those cards, well, you have access to max out all of that credit limit, and that puts the creditor at risk because now your income won't be able to cover it. So there's a lot of things to consider. But credit cards can be tricky, but the key that I always say is you have to utilize them in a way that's beneficial. And the other tip that I was sharing is some people, and I seen, he was a doctor years ago, he was using his credit card for every single purchase that he made. Instead of paying for things that he was already gonna buy, like his car notes, his electricity, all of those fixed expenses, he used his credit card first. And then the cash that he was going to use to pay for those things, he paid off the credit card. What that was doing was giving him points, rewards, right? And then after a period of, I think he had it for like 3 years, and he had forgot that he was earning the points, he got like $1,800, right? And it was a really big reward return for things that he was already going to pay for. But the key is you have to have the money to back it up if you're going to use that plan, right? So that plan can be efficient. But it's all about being able to be disciplined because you can try that method where you're using the card for all of the purchases that you were already going to make, but then you added another purchase and you added another purchase that you weren't going to make. And now when it's time to pay it off, you don't have quite enough to cover it, right? And so you've got to be really cautious, really disciplined to make sure that you stay inside those bounds. But I think that in today's society, unlike my dad's, you do probably have to have a credit card or two to make sure that you can make it out. Now, there are all kinds of different cards. There's rewards cards. There's credit builder cards like a secured card, which is something that WaFd offers, where you can put your own money down, right? And when you put your own money down, it allows you to borrow the money that you put down and report to the credit bureaus that I'm making these payments regularly. So in essence, it helps you to build that credit score while limiting your risk as well as the risk to the bank, right? And so that's a really good credit builder. There's rewards cards for flights. There's rewards cards for different things like DoorDash and those types of things. You get a lot of perks and benefits. And they're enticing. They do this intentionally to kind of bring you in and say, hey, get this. But again, you go back to who? Your financial professional, and you say, hey, does this work for me? Why does this work for my life? How is this going to benefit me? And what are the risks that I'm going to be taking in doing so? And I think a good banker will tell you, hey, you're not the person for this card. And sometimes it has to hurt your feelings when you say, hey, you haven't displayed the discipline necessary to do this. Now, there are laws that say that you can never discourage a person from applying for any kind of credit product. However, your banker can be honest with you and say, hey, based on what you've shared with me, based on the relationship that we have, I don't recommend that you do this right now. Now, you have the right to do it, but they can say to you like, hey, this might not be the best thing for your path right now.
So before we leave credit, I also wanted to talk about paying off that minimum balance.
Yes.
So do you, as somebody who, when you have your credit and you're paying off just the minimum balance, what kind of path are you headed down?
Okay, I'm glad you brought that up because I did mean to talk about that, right? So with a credit card, you're given, and I should have started with the basics to begin with. So a credit card is, it's a small loan, right? Small being a relative term, because credit cards span for different amounts, right? But let's say you got your first credit card and they gave you $1,000. So your $1,000 becomes your available credit line. That means you can spend $1,000. You go out and you use $500 off of your credit card. When you get the bill in the mail, they're not going to say, I need $500 back. They're going to say, here is your minimum payment due, right? And that might be as little as $25. Now I'm going to tell you a bit about myself, because I always said my background in finance wasn't always in banking. I was a college student once, right? so this is a long time ago, so I guess I'm dating myself a bit, right? But I walked onto the college campus and there were these tables set up and there were offers and signs, but that's not what intrigued me. They had snacks. I'm a big guy. And I was like, snacks? What do I have to do for these cookies? They're like, nothing, sign this paper. And I signed the paper and I did it, right? And so they gave me my credit cards. They came in the mail. And at the time, Jabos were popular jeans back in the day. I don't know if anybody even knows what those are, right? But I went out and bought all the Jabos I can get my hands on. And I maxed out the cards. $500 was the first limit. And I was paying regularly. They sent me the bill in the mail. They said $25 is what you have to pay. And I paid the $25. And then the next month, they sent me another bill and it was like $25. No problem. But mind you, I had already spent the other $25, right? And then they sent me another bill for $25 and a year had passed. And I still owed like $450. And I was like, why do I still owe so much money on this card? And I have been paying and I was using as well. But I have been paying and paying and paying. And so that minimum balance was being eaten up by that tricky word that we talked about in the beginning, interest. The interest. So of the $25 that I was paying, only about $5 of that was actually going towards what's called the principal balance, which is the balance that I owed. The other $20 was going towards the interest, which is the cost that I was paying just for using the card, right? Mm-hmm. And so it's important to know that paying those minimum balances, while they can be advantageous to you if you're trying to get it to a point where you're reporting that I can carry a balance and pay for a bigger period of time, they can also be a detriment to you if you're underwater. It's one of those situations where I can't pay anything more than the minimum, right? And a lot of us have been in a situation, I don't want to quote the number because I don't know it offhand, but in today's society, many people carry credit card balances well into the tens of thousands, right? And what's happening is they're just making those minimum payments. When you look at, and there's calculators that you can find online, right? And those calculators will let you know the year span that it would take to pay off those credit card debts. And it's astronomical. You'll see 20, 30-year time periods that it would take to pay off paying the minimum balance. So some people use the snowball method, where they pay the smallest and they put as much excess cash as they have to paying off the smallest first, and they snowball into the larger ones. It's a complicated method. It's hard. So what do you do to prevent that, right? Discipline. You make sure you don't put yourself in that situation. Now, I'm a realist, so I know that there are times in life where we're going to put ourselves in situations or life's going to put us in situations that we don't have a choice. But it's important to make sure that you do everything that you can to fix that situation. And even then, you want to talk to your financial professional, because there are times where you find yourself in these problematic areas. You can call them and say, hey, I'm going through something right now. I've got a situation. What can you do to help me be able to mitigate this situation? And they often will have some kind of program or something to assist you with that. But paying minimum payments is, for lack of a better term, it can be a death sentence to your finances, right? If you're just paying the minimum. So I think that it's very imperative that we make sure that we are disciplined first, and then always try to pay more than the minimum, even if it's just 20 or 30 bucks, because that excess goes directly to your principal, which will eat away at what you actually have to pay. Thanks for asking that question.
Thank you. That's a great answer. So the next thing we were talking about, I'm going to segue kind of backwards from what we talked about, but we talked a little bit about scams. And so I wanted to get into that because obviously credit cards are not, blanket statement, not a scam, but it's easy to find places that kind of look like a credit card.
Yes.
And so, just talk a little bit about what you need to do to protect yourself. Just figure out what is the real thing and what is the scam, and what can you do to protect yourself and your family.
This time I'm going to start with your financial profession.
Okay.
Right?
Yeah.
So immediately, if you're not 100% certain, call your finance. Don't call the number on please don't call that number, right? Don't call that one. Call your financial professional. Have you a banker who you can be like, hey, I got this in the mail. Can you make sense of this for me? I always say sometimes it's good to call a friend who might know somebody, but call somebody first. Sad story, my parents, again, I told you they're older people. They're facing scams right now. I think their phone rings more for scam callers than it does for anybody else, right? I've gone over there and I'm like, within 15 minutes, there's like 5 or 6 calls. Let me tell you about Medicare. Let me tell you about this. And I've gotten my parents to a point where I'm like, hey, every single time somebody calls you and asks you to buy or to listen, call me, right? And we'll talk to them together. But the way to watch for those scams is usually if it's urgent. If it's urgent, there's something going on because most legitimate things take time. Have you ever done anything in the court system? It's a slow process, right? Have you ever done anything at the bank? It's not quick, right? So if it's urgent, do it now, be leery. If it comes in an envelope that's unmarked, or if it looks like a check for some reason, and you're not expecting a check, be leery, right? If it comes with instructions where it says, hey, this check belongs to you, but we need you to send this amount back so that we can send you this amount, be leery. Right? Now, not everything is a scam, so you can in fact check with your banker, check with your financial professional and say, hey, this is something that I received. Can you tell me a bit more about it? And the old adage, if it's too good to be true, it probably is, right? And so those are some of the things that we see. One of the bigger things that you see in the banking industry is you'll get a check in the mail that will say, hey, this is for a job that you applied for online, and if you did apply for it, it may not necessarily be a legitimate job, but it's something that you should check into. They'll say, hey, this is your first payment, send us this amount back, and then you keep the rest to get started with work. It's not legitimate 90% of the time. But the biggest thing that I think that we have to be leery of today, and it's gonna be a challenge for all of us, is AI. AI is creating an environment where it's very, very difficult to tell what is fact and what is fiction. Right? And so you have to be very diligent about making sure that you ask questions, making sure that before you provide any information, especially pertinent information like your social security number, your address, before you provide any of that information, you're going to want to speak to someone else, right? Get a second opinion. I always say that if somebody calls and it's a creditor or somebody, posing as a creditor, have them mail you the information. Because if they say, well, I can't mail it today, then there's a good chance that it's not legitimate. There's also scams that are related to family members, and they like to prey on the elderly community. Your child is in danger, and they need you to do this, and you can't talk to them now. Reach out to your child if you can first. If you can't get in touch with your child, reach out to law enforcement. Reach out to someone else before you just immediately, and I know because they prey on your sensibility, your humanity, and they want you to feel like I've got to do something quick, right? But do take a moment and really understand that. And again, reach out to your financial professional. A lot of banks have somebody that you can call almost at 24 hours a day, right? But scams are huge for me because of my parents. My dad was recently scammed for $2,500. Somebody told him that they could help him out with a healthcare situation. He got in the car with him. This is an in-person thing. He got in the car with him, and they took him to the bank. And I mean, he lost $2,500, but I was like, you could have lost your life there, you know. And it's important that, you know, myself, and my generation, that we reach out to our older relatives, and even younger people are not, you know, impervious to scams. Like they still have scams that younger people can do, but they typically target our elder generation. But it's important for us to be a line of defense for the elder generation and say, hey, let me check in on you. What do you have going on? And that leads into conversations about money with your parents. One of the things that I've started to have conversations with my parents about is, where do you have bank accounts? My dad, why do you have so many bank accounts? Like, what, you're not keeping much in any of them. Why do you have so many of them, right? What are your plans if something happens to you? Who do you want to be in charge if something happens to you? Do you want a power of attorney in place? Dad, do you know what a power of attorney is? Do you have a will in place? Dad, why do you need a will? But it's important for us to start having those conversations early on, because that's how they fall prey to those scams. It's because there's nobody really standing in that line of defense for them. And the same happens with younger people. And I keep pointing that out because you may not have anybody who can step in for you other than your financial professional, right? So, yeah.
Well, that covered all of the questions that we were talking about, and wanted to open it up to there's a few people here in the room, and if anybody else has questions or concerns you'd like to talk with our financial advisor.
I just want to make a comment when you talk about credit scores or getting your score. Credit Karma, because you were talking about paying annually or getting a free report annually, but you could pay to get one. But Credit Karma, and I know that they probably make money because they're always trying to show you cards that you qualify for or loan to a side, but they are, I think, very consistent with their information on providing your credit history and your accurate scores. And I mean, I get emails from them every couple of weeks. They're like, hey, you're doing great, or hey, check this out, your score changed, or they'll alert you if there's been a hard
fraud
check on your score. So, I mean, that's really an easy way, I think, to get a very regular look at your credit scores for free. That doesn't put a ding on checking it. And also, if you have an Amex card, and maybe other cards, I don't pay attention, but an Amex card provides a credit score in one of the services.
So I will say for Credit Karma, and I'm really cautious to talk about any other business, but Credit Karma is what I like to consider gamification of credit scores. And I think it's a good thing, because the gamification of the credit scores allows people to be more engaged. It gives you a lot of different meters and feedback, and it says you're doing great. It gives you a lot of accolades for the things that you're doing. However, Credit Karma is notorious for being very far off on your credit score. So they're usually like 10 to 50 points off of your score, right?
So I recently purchased a car last month, and the dealership that ran my credit score, I told it what it was, basic credit card amount, and I think it came in pretty much in line with.
That's awesome.
So
Just,
I don't know.
and
I'm
yeah,
not saying
no.
it can't fluctuate,
Yeah.
but I understand what you're saying.
But like I said, I encourage people to use those types of things because some information is better than no information.
But it also
right?
aligns with what Amex says. So do you think getting information from like a credit card, like a reputable organization or company like American Express is accurate?
Accuracy is in question with any of them, not because the score isn't accurate itself. It's because of the score that's being used by the creditor, right? So there are multiple different scores out there. So there's a FICO credit score, there's the TransUnion score, the Equifax score, the Experian score, and then there's other scores as well, right? And all of those scores are accurate for the algorithm that they are using to determine. But not everybody's looking at the same thing. Why isn't everybody looking at the same thing? Because not every lender, not every creditor reports to every agency, right? And so some of them will have other things that are not on that report, which is why whenever you go to a lender or you go to a creditor, right, they usually take the average or a middle score, right? And because what they're doing is they're looking at what everybody has to say, and then they're kind of putting it like, oh, okay, this is about the average, this is about the middle point of what it says. And so the scores aren't necessarily inaccurate, it's just may not necessarily be the score that's being used at that moment. But
in
yes,
addition to the scores, they do provide you with, I think, valid information on your credit utilization,
Yes.
and your history and your accounts, and
Yes.
what's been closed and what's open, and stuff like that too. So that's
Right.
also just good tools.
It's
to have.
a great
If your
tool.
scores are wonky.
Absolutely.
But I did have another question more about, high yield savings accounts.
Yes.
Because I know, like, in recent years, you know, like you can get a, like 5% interest rates and, 4.5%, 5%, whatever, at reputable,
Mhm.
companies. But now things are dropping again. So, I've noticed that from a couple of our different accounts, that there's one that remains higher. Do you think it's smart to move, based on like half a percentage or so, is it smart to move money back and forth?
So I'll
if
start.
you're at past the maturity date?
Long answer, short question, right? So the long answer is, one, to understand how this works. I have to help you understand how money works for the bank, right? There's a reason they offer high yield savings. It's because of the cost of money, right?
Mm-hmm.
That cost of money is how much they're paying to borrow the money from the federal government or wherever they're getting their funds from. So they pay the high yield savings rates. Why? Because your money doesn't have a cost. The cost is the interest rate that they're paying you. That's the cost. So the larger the amount of money that you put in there, usually you get a higher rate and they're paying you. But that's pennies compared to what they would actually be paying if they were borrowing those funds, right? And so you'll see those rates change from there. So you'll see that your larger institutions, and I'm not going to name any of the names, but the larger institutions, they typically don't have to pay you a higher rate. Why? Because they're able to borrow money from the federal government at a much cheaper rate. The ones that are lesser known banks or the lesser known institutions, they pay a much higher interest rate. Why? Because it costs them so much money to borrow it, right? And so if they can get it from you, they're getting it for pennies on the dollar, right? And so to answer your questions more directly onto, does it make sense to change for 0.5%? Probably not, right? And here's why. Because that relationship could change drastically with the federal government, right? They may not always be in the situation that they're in. So what's really more important when it comes to moving your money from one place to the next is security of your funds, right? Is the bank a stable bank? How long have they been around? What kind of things have they gone through? Have they made it through the 2008 situation with the mortgage crisis? Did they make it through the Great Depression? Have they been around that long, right? So you want the security, but also the relationship that you have with your banker. Are they in my corner? Can I call them when I need them? Because the more that you have at one institution, the more they're willing to do for you. And that works the same way with any other organization, any other business that you're doing with. The relationship that you build is much more important. But if you're always changing from one bank to the next, you don't really have a relationship. And it's just, you're gonna earn a couple more cents. And usually the interest rates are not so drastically different that you're going to make enough money to make it worth it. I've seen people move hundreds of thousands of dollars to make 10. It just doesn't, your time is worth more than that, right? So that's the short answer to that. Any other questions?
Can you, I know we were talking about this before you had your conversation, but you talked about for small business, for entrepreneurs, and I know that's gonna probably be another discussion. What did you call it, express loans?
Yes.
The reason I invited you is I wanted to hear that part.
So WaFd Bank has a new product offering that we're offering at the moment. It's called an express loan, right? So right now we're offering up to $50,000 for small businesses that have been in business for about 2 years or more, with no income document required. So that's really awesome because it's able to get those newer businesses funding that they need for purchase orders, right? You can have a line of credit in place so that if you need to float payroll so that while you have receivables coming in, you can pay your employees, you can get all that done. And $50,000 can be a game changer for a small business. But on top of that, we're going up to $100,000 where at the $100,000 or to the $50,000 mark, we do require income documents, but it's low barrier and it's quick. You know, right now I've seen some of those loans actually turn around within 2 or 3 business days, which is awesome. You know, but the big thing is I come from Louisiana, and coming from Louisiana, hurricane central. There's always hurricanes, always hurricanes. And we've all heard, most of us may have heard of a home equity line of credit, right? And so a home equity line of credit lets you borrow on the equity in your home. Well, in Louisiana, one of the things that the bankers will often say is, get your home equity line of credit before hurricane season. Why? Because legitimate things are slow, right? And because they're slow, what happens is you now don't have a roof on your house, and you have to do the insurance claim. And the insurance claim is like, hey, it's going to take a couple weeks, so you got the blue tarp on top of your house. But if you've got that home equity line of credit in place now, you fix your roof, you wait on the insurance company, you pay off the home equity line of credit. The same works in business, right? So with that business line of credit, I always say get it before you need it, right? If you have it in place, then you have that huge purchase order that comes in, and they're like, hey, I need you to do X amount of units, and you don't have the money in place now, then how do you do it? But if you already have the money in place, you'll be able to take care of it. Or if receivables come slower because of your net 30, net 90, and those types of things are slowing up your receivables, you can still pay your employees or take care of what you need to do because the line of credit's there and you can pay it back. So it's a really good thing to have in place in the event that you need it. It's safer insurance, if you ask me, right? I don't know if I can legally say that, but for me, it's just that peace of mind that you're getting from having that in place. And WaFd it's a very relationship bank. For the last 100 years, I was sharing that we have been what's called a portfolio lender. Now, we're kind of moving out of that sector, not because we don't still believe in that, but it's because of the climate that we're in with our economy, right? But what we still retain the same thought process. We like to be in the trenches with our clients. And what a portfolio lender is when we create a loan, we keep it on our books. Why is that important? Because with larger institutions, they will create the loan and then they'll immediately sell it. And so it's not my problem anymore. It doesn't matter if you make it or not. But when you keep that loan, it matters to me if you make it, because if you fail, I fail, right? And so we've created those relationships with our clients where we know that if something's going on, call your financial professional, right? Ask them, hey, I've got a situation, can you help me? And so during the crisis of 2008 with the housing, we kept a lot of people in their houses. And that's major, where a lot of the other institutions was like, hey, you don't got it, you know? And so it's important. And we're pivoting now with this organization into focusing on small business, because I personally think that small business is the lifeblood of our economy, right? We've got all these super major organizations, but we really can't put all of our faith in those organizations, because if one of them fails, it can take out the entire economy, right?
So the statistics for Vashon County is 70% of small businesses, 70% of small businesses under 10 people.
Yes.
And then I think it was 60-something under 50 people. So that is a lifeblood.
It is the lifeblood. And
does
so
your bank do home equity loans?
we actually just got out of the home lending business about 4 months ago, don't quote me. We got out of it because we recognized that we weren't the best for that thing. There are other options that are readily available, easier to do. And so you just got to kind of know your lane sometimes. And so our focus has been small business and helping the small business owner. And of course, large business. We are a commercial bank in essence. So, I mean, we can do some pretty serious lending. But the goal is to be able to help on a personal level. All of our underwriting is in-house, which is huge as well. You know, you can actually talk to the underwriter. One of the main reasons I moved to WaFd Bank, I worked for a larger institution for over 10 years. But when it came down to lending, when it came down to getting things done for the community, it was always, that's too small. Or all it mattered was the numbers, right? Here, I'm able to put a narrative. I'm able to say, hey, this is what this individual has going on in life. This is why this makes sense. This is why we should do it. And the underwriter can take into consideration other things rather than just the numbers. And I like the fact that we've been able to work with a lot of different nonprofits. We've been able to give out grants in the community. Last year, we gave out over $100,000 in grants just in the Austin area, right? We're able to volunteer. We've been in community gardens. We've sponsored soccer teams. We really get to get out into the community and give back rather than always being an extractive industry where banks are usually like, I need some more. I need some more. We're able to give a lot more. And that's what I really love about WaFd. My boss likes to say it's the honeymoon phase. And he's been with the bank for some time. And he's like, the honeymoon phase never ends. And I'm like, don't tell me anything else about the honeymoon phase, Jim. But he's right. He's right. It doesn't end. I really love WaFd because it gives me the ability to truly do these types of things, and they make sure that we're taking care of the community. Yeah.
Thank you so much.
Absolutely. Thank you guys.
Thank you so much. Thanks to everybody who was able to attend today. Jose is going to be posting this online, so thank you to everyone who's watching. Thanks again, Dan, for that. So appreciate you being here and all the information that you provided. And again, thanks to Greater Fayette Community Foundation. I get it all. Thank you, everybody, very much. And we'll see you. The next one is going to be Thursday, so in 2 days. And then the final one for this series is going to be July 8th. And that'll be from renter to home ownership on Thursday. And what do you need to know about inspections on July 8th. Thank you all very much.
Thank you.